Welcome, welcome, welcome. I am Johnita Stanton, the really bratty real estate brat. We got Reginald Perriman, Master Sensei, Shaka Williams, the real estate guru extraordinaire, and James Tavegia. We're going to call you the master of the Southeast in mortgages.
All right.
All right.
So I had to do something a little bit different. I felt like, we need to break the ice, have a little bit of fun. And I don't know, I'm in a silly mood. So y'all got to bear with me today. Just what it is. Freestyling on the mic.
All right. Good.
James, tell us a little bit about yourself and how you got started.
Okay. So I went to Walsh for finance, and my best friend at the time was working at a place called Rock Financial. And I was terrified because I had cousins that went to school, graduated earlier, couldn't find jobs, and they're like, you got to get something in your industry. You got to get some kind of a job having to do with finance. No idea what Rock Financial was, but my buddy was working there, had a car, a house. I'm trying to bring pop cans back to the store to fill my gas tank at the time. And I just got into a conversation about what he was doing and how he had done so well for the years that we had kind of been apart, and told me, hey, I work at Rock Financial, I'll get you an interview. No idea what I was interviewing for. I just showed up scared as possibly could be. And I must have had a little bit of charm because the guy that I met with, gentleman by the name of John Jurkovich, he was the DVP for their Farmington Hills location. And he hired me. He kind of hired me on the spot. And that's really how I got into it. June 2004, there was 100 people in my training class. So it was crazy, but I figured out that I loved it right away. I finished top in my class.
Sweet.
And I've been working my tail off ever since. But it's actually June 4th, which is today.
Yeah.
Yes.
Yep.
No, tomorrow's June 4th.
Yeah.
Saturday, June 4th. Today's Friday, June 3rd.
18-year anniversary as a mortgage professional.
Wow.
Okay.
Yep.
So you went to school for finance, right?
I went to school for finance and ended up doing something that requires really not any kind of formal education per se.
Right.
A little bit of crazy to do what I do at a high level is really what it takes. Good with numbers.
And not just school. He went to that's a high level
Yeah,
school
Walsh.
for a business.
Yeah.
Yeah.
Private college. Yeah. It's all right.
The reason I brought that up, and you mentioned it, so a lot of loan reps and realtors, they get in because the barrier of entry is so low. Mm-hmm. And rarely do you find an actual loan rep that went to school for finance. And you're trusting them with all your financial well-being pretty much to get that loan. So that's good.
Yeah.
That's good.
Yeah, it was an eye-opener.
Right.
I like people. My whole family has a history in sales. My dad was a VP for Art Van, 40-plus
sweet.
years with the company.
Right.
That's really why the guy hired me. He started getting into my family background, and even though I didn't know a dang thing about mortgage, he's like, well, you seem pretty likable, and you're going to school to learn about money, and your parents, family, have a history of sales. They gave me a shot, and I love people. I love numbers. I like complex situations. I like figuring it out.
Mm-hmm. It's a pretty good financial career too, right?
I mean, it's. Hey,
I mean, the money's not bad.
It pays the bills. It definitely pays the bills.
So what are you doing now these days? Okay, so you started in 2004, which was about 4 years before everything went to shit.
Yep.
And when that happened, what did you do?
Panicked like everybody else. Kept my head down though. So I was part of a team at Quicken at the time, where we had to, they called it the war room, and we had to go in and try to take all these non-saleable loans, all these option arms and interest only and stated income, and ultimately we were trying to create new loans that were insurable and that the stock market, mortgage-backed securities that they could pack up and actually sell.
Right.
So that was kind of a unique thing, because you're calling clients that just refinanced and you're trying to get them to go into a different mortgage, and I mean, it was tough, but HARP came in 2009, and it started out 105%, total combined loan to value. So we were able to start refinancing people that were underwater, and those guidelines continued to loosen up, and all of a sudden it was a new wave of business.
Okay.
Explain HARP.
Yeah.
Yeah.
Home Affordable Refinance Program.
Right.
So loans that were ultimately insured and owned by Fannie and Freddie, you were able to refinance those mortgages for those borrowers because rates had dropped significantly, but so had home values. So a lot of people that at one point in time had a significant amount of equity in their homes no longer had equity.
Right.
And it started out light. They owned the paper anyways, so I think they finally brightened up to the fact that, hey, we need to figure out a way to keep homeowners in their homes. And we were ultimately, by the time HARP was said and done with, there was no equity restrictions. So you could refinance if they were 200% backwards. And then we just made a crushing in that market, quite frankly, and that's how we survived 2008, went to 2009. 2009 was a really good year, 2010, 2011, and I would say probably somewhere between 12 and 13 is really when the purchase market came back.
Right.
And I left Quicken in December of 2009. I went to, at the time it was National City. Within a week of me starting, it was acquired by PNC Bank.
Oh, yeah.
And it was a mess. And I had a year there where I was like, if this is mortgages, I don't think this is what I want to do. I mean, it was terrible. Right. It was my first experience leaving a place that was very organized, a lot of tech,
right.
Very, very structured, to a place where they just handed me a laptop and said, all right, good luck. It's like,
Make
wait,
it happen.
what?
Yeah, structure is important. So you brought up a good point. So that time period between like 2008 and everybody was panicking, right? But he said something that 2009 was a great year because a lot of people don't understand there's a lot of opportunity in a down market like that. There's always one or two niches you can find and make good money in.
And his was refis. So
Yes, sir.
refinances. So it wasn't a good year for everybody. It was a good year for people that was, it wasn't necessarily a good year for everybody in real estate.
But
he was in a certain niche.
In 09?
Yeah.
It's always a good market for somebody.
Yeah.
Right?
Yeah.
You just got to, as a professional, you got to find
Pivot.
out where your niche is. Exactly. Yep. So those refinances, so someone, their balance is $200,000. Their home is probably worth $140,000 at that time. You were still able to refinance them, and maybe they were getting a lower rate or doing a loan mod so that they can afford to keep their home, basically.
Precisely.
Okay.
Yep. I didn't have anything to do with loan mods. There was a lot of financial institutions made those available, but
Okay.
we did an actual transaction, and rates had gotten down at that point in time. I want to say probably low fours.
Yep.
Right.
And, people that were in the sixes, I mean, I lived through 6.875, 7.25 on a 30-year fix for a small amount of time there. So
Right.
people were able to convert from 30s to 15s
Right.
and have a comparable payment, save them hundreds of dollars on their current payment. I mean, we really kind of put a plug in the disaster
Yeah.
by allowing people to stay in their homes and reducing the monthly payments.
Right.
And then all of a sudden, because, I mean, at that point in time, it was like, well, heck, like, my next door neighbor just lost his house, but before he lost his house, he bought the other neighbor's house half off.
Right. Yeah.
So it was like, what was the motivation, to do that? People were literally buying new homes to let their existing home go.
Yeah.
You get a slap on the wrist. If you're smart, most people filed for bankruptcy, absolved themselves from the debt. Obviously, there's a financial time period that you have to go through. It's a little tough to get approved for anything, but if you already got the new house,
Right.
Your car and everything.
Yeah.
You're not getting credit
Get everything
cards.
first.
yeah, you got the
You showed
neighbor's
a neighbor
bigger house
then,
for half the
half
payment
the
you were
price.
floating up to it. So
Right.
I got a question. So, so do you see any similarities now to like 2007, 2006 or 7-ish?
Yes and no. Nothing like back then.
Right.
Like back then, if you had a heart, a pulse, and a credit score, here's a mortgage. I mean, it was ridiculous.
Yeah.
That was the Wild West.
Right.
Stated income, stated assets, no problem. Here's some money.
Good.
Just had to score.
Yes. Yeah. Everyone. You get an approval, you get an approval, you get an approval.
5 approvals.
Yeah. Exactly.
You can buy houses.
I think as of right now, it's a great thing to touch on. Non-qualified mortgage products are making a return in a big way.
That's the similarity, right?
Yes, but it's not like it was. So bank statement loans are a hot topic right now for self-employed clients.
Right.
My wife's self-employed. Most of you probably are self-employed, 1099, or you have your own business set up. Well, the point of being self-employed is to take advantage of every single one of those write-offs.
Right.
And if you're anything like my wife, I mean,
everything.
everything. I get yelled at for paying anything if it ain't on a business card kind of a deal. So, the flip side is you're filing your tax returns, and this is what you're telling Uncle Sam you're making. But in the mortgage world, it's like, hey, no. I do a little bit better than this.
Right.
So they're coming out with creative ways to help people that are self-employed get mortgages where you still are qualifying the income, but not the standard conventional ways.
Right.
So you explained it a little bit, but explain to them what you just
non-QM, non-qualified mortgage.
Right. So what I'm hearing, the similarity is the programs are similar, but the qualification process is more strict now.
Yes.
Compared to back then.
Precisely.
Okay.
Yep. I think hard money is becoming a more accepted way of getting financing terms done as well. Right. And not that hasn't been around, but I think more people are getting into it from an investment standpoint because the values just keep going up.
Right.
So if you've got maybe not the traditional way to be able to get credit, this is a way that you can get a loan where you still have some skin in the game from a down payment standpoint, and there's less risk because the collateral is something that's been appreciating now since really 2009.
Right.
But really appreciated in the past 2 years.
Yeah. What are those mortgages, or what are the loan to values on those?
So typically, it has a lot to do with reserves, FICO score, but typically you're going to be a minimum of 10% down on a program like that. 20% down is more favorable, and then we have a 12-month program and a 24-month program. So if we're collecting 24 months worth of statements, right, a little bit more of a law of averages used, considered less risk, so you're going to end up getting a little bit better pricing, but they literally take a percentage of the deposits that are coming into your account, your bank account, business account, and that is ultimately your qualified income.
Okay.
And we have other ones that there aren't restrictions on how many investment properties you own and finance. We have interest only coming back, which I don't think it's a terrible thing used for the right purposes.
Right.
Like all of California is an interest-only loan because you can't afford the payment anyways. You can't get a one-bedroom shack for less than $700,000 in most parts of California.
Right. Yeah. So and then 20% down is not a bad thing. No. Right. Like Dave Ramsey lived by it. You shouldn't buy unless you can put 20% down. Like, why would you put 20% down? That's always the debate, right?
Yeah.
If you were a smart if you're an investor, but if you're a typical homeowner, it's a lot of reasons why you should, in my opinion.
Yeah, it
you should.
Yes.
Yeah, it depends because what else could you do with that money?
I mean, those are the conversations that you have with, the client has with some sort of, financial advisor or whatever. But like you said, sometimes leaving the cash liquid could be better. But if they don't necessarily know what they're going to do with it, or if you're, I always tell the story about my oldest. When she was getting ready to buy her house, I knew that they were going to blow the money. So put it into the house.
Yeah.
And since you put it into the house, now you have this crazy low payment that you can't even, you would never see it even in, rent or mortgages at a low rate.
Sure.
So,
And equity.
And equity.
Right.
Especially right now.
Yeah.
What are the rates looking like for those type of mortgages?
So... you guys are going to kill me on this off the top of my head.
No,
it's all good. I'm going to tell you a range. Typically, you're going to be anywhere between a point to a point and a half off of just standard insurable market.
Right. Gotcha. Okay.
So if I'm at 5.25, 5 3/8 today.
Right.
Add anywhere between a point to a point and a half, depending on how many statements we're collecting, what that credit score is.
Right.
Minimum FICO score requirement is a 680.
Okay.
Optimal would be 740 plus, and they're going to make adjustments to margin, which means higher rate, appropriate with whatever those different parts are. More of a down payment's always a little bit better of a rate.
Right.
Those types of things.
So basically, you're minimizing the risk. So they're paying a little bit higher rate of interest because they're not a conforming traditional loan.
Precisely.
And they're putting a higher down payment to minimize that risk. And they can't come in with the 620 credit score in most cases.
Are you
Correct.
seeing the buy downs coming back at favorable terms?
I refuse to believe in the buy downs. Historically, I think in previous years they've probably made sense. I might be the only one that thinks this, but I'm not the only one that thinks this. The smartest guy in mortgage, a guy by the name of Barry Habib, is who I got this from. But quote unquote, he says we have not seen the lowest rates in U.S. history. And this is the guy that consults Fannie, Freddie, MBS Highway. He owns that company.
Okay.
I subscribe to him, so I get text messages before the market's going to take a dump, or if I know rates are going to get better, I'll hold off on a lock. But this guy is pretty much what we consider the mortgage guru of the world.
Wow.
And
he said it's going to get lower. I mean,
Yep.
it's lower than it was.
yeah,
Goodness.
that's what he says.
What causes that?
I think we're in a recession, and nobody actually says it or realizes it yet. And it's not going to be anything like 2008, but we're in for some changes. I mean, they have to keep increasing interest rates to keep inflation in check. They've been lending money for literally nothing.
Right.
Because you still get the tax write-off on that interest on top of paying a 2.5% interest rate.
Right.
So if you want people to go back and invest in the bond market, you have to make the rate of return desirable.
Right.
And the only way that the Fed can try to combat inflation is by increasing interest rates. So that's why you're seeing what you're seeing. And I think historically, I don't know if we've ever had this high of an increase as quick as it's happened.
Exactly. Yeah.
What do you think about currently, is it a good idea, a bad idea to purchase? Or I think the question is more so like for the people who are kind of like, oh, we're just going to wait for the market to have a turnaround.
So whenever I hear that, I think of that Tom Brady meme. I don't know if you've seen it, but they post it all over real estate websites. Like they say, I think I'm going to wait till the market crashes. And then you see like Tom Brady in every year of football.
Right.
Like literally winning up to the year that like he retired and then came back. And I honestly, I don't think that real estate's going to come down drastically. I think the market has already kind of corrected itself.
Yeah.
It's still super busy. There's still more buyers for every home out there. Like
Right.
it's not one buyer to one house, right? There's probably still statistically 4 to 5 buyers for every house on the market.
Exactly.
Price of material is outrageous. Although the price of lumber has come down, it's still crazy in comparison to before COVID hit. So you have all these different companies that had to shut down manufacturing. There's a shortage of goods, shortage of cars, shortage of everything.
Workers, shortage of workers.
Yeah.
Working.
Nobody wants to
That is
work.
the issue.
Nobody wants to work.
That's what's
Yeah.
really causing everything is the shortage of people working.
Yeah.
That's why we have a shortage of everything else.
I can't even rely on Chipotle for lunch anymore.
Yeah.
Sometimes they just shut down because
Yeah.
they don't have enough staff.
Nobody's showing up. It's crazy.
Like we got it.
Yeah, but then they all want mortgages.
Imagine Cash Money,
Right.
Gator boots with pimped out Gucci
Right.
shoes. Ain't
Yeah.
got no job, but I'm still fly.
Right.
Can't pay my rent.
Yep.
All my money spent.
See, yep, there we
you
go. Raise the roof like from Bo.
Right. Yeah.
No.
Yeah.
Oh yeah.
So,
okay, we digress.
So what's funny is, you said you started in 2004.
4.
All right. 2004, you go through the whole cycle, and now we're here. Does it amaze you how many people were like going crazy because the rates went up to past 4%, reaching up to 5%? Because you remember when rates were much higher, right?
Oh, of course.
Yeah. So
To me, this ain't bad.
okay, that's what I want.
Historically, it's
Yeah, it's still a low
It just
rate.
hurts a little bit. Like even for me, my personal story, like you're doing my refinance, right?
Yes, ma'am.
Okay. Like 9 months ago, I could have gotten a 2.75 or 8 or something like that.
Not even that long ago.
Yeah, not even that long ago.
November. That's when they changed. That's when they started getting for the worse.
Yeah.
Yep.
And so now it's more so like a 5.5. That's like almost a 2.7 to 3%, it makes you want to puke a little bit. So no, like historically, when you think about it, it's not bad still, but it's like, God dang it.
Right. What I could have did. Right.
And it's like the real version of hindsight is 2020, because you still have those conversations. Like, are those people, investors, people wanting to buy? Probably like 2020, and they're like, "Oh, it's a bad time. The market's going to crash."
Yep, they were wrong.
Yeah.
Right.
2020 gave like probably an average of 20% in the wrong.
Yeah.
And last year too. I mean, homes are still appreciating.
Right.
It's mind-boggling to see. Because I look at the appraisals, and I deal with some clientele that just throws stupid money out there in the form of guarantees, and the appraisals come in low, and it's like they don't even bat an eye. They're just paying it. So as long as you've got that kind of demand, it's going to keep the values up, because that now becomes a comp, and it establishes a new, level for what a house in that subdivision is going to go for.
Right.
And every time I think that things are going to straighten out, I get another one of these clients that's willing to pay stupid money for the house that's not going to appraise.
Right.
So you feel like you're still having that often?
I just had an appraisal. It's in Auburn Hills, 650 purchase price, came in at 557.
Right.
He didn't even blink an eye.
Wow.
Yeah.
And he paid the difference.
He's putting 30% down to start with. Okay. So realistically, now in the frame of the mortgage itself, it's like he's putting 20% down.
Right.
So his terms don't change. He's not paying private mortgage insurance. The loan amount stays the same. The payment stays the same. It's just, I'm buying something for more than what it's actually considered worth.
Right.
But his comp will now help out everybody in that 1 mile square radius, and they just keep going.
Right.
Exactly.
I want to go back to something you said about the buy down. You said you don't like that. Can you explain that?
I was thinking that in my head too. I'm like, we're going to come back to this. I don't believe in the buy downs for this reason. I'm not going to say always. Rate sheets are constantly evolving, constantly changing, and Fannie and Freddie really dictate ultimately what the differences are. So you referred to something as a 0-point rate. 0-point rate is the interest rate that's available for let's just say a 740 FICO score, because that ultimately creates the best option for you, plus down payment or equity position, okay? So buy downs ultimately you are paying a percentage of the amount that you are financing in fees. It is considered a prepaid interest, so it does become a tax deduction, but the bottom line is that you're creating a lower payment with a lower rate because you're paying more money to get that rate.
Right.
And there's going to be a definitive amount of time that you have to be in that mortgage for the amount of money that you paid. So example, let's just say you have a $100,000 loan and you're paying, 1% or 1 point on that loan to get your interest rate down by 1/4 of a point. I'm just using a common example.
Right.
So you're paying $1,000 to have this interest rate that's 1/4 of a point lower. So whatever the 0-point rate would have been versus the interest rate that you just bought it down, there's a monthly payment difference. And you take that monthly payment difference and you take that $1,000 divided by that monthly payment, that's the amount of time that it takes you to recoup the money for that lower rate.
Right.
Well, just theoretically, what if a year from now, all of a sudden interest rates drop by a full point?
Right.
Well,
you lost that money.
That money's
You
gone.
just paid-
you're not
you paid
gonna
$1,000.
stay in the mortgage to spite yourself to make up for the cost that you paid to get it. You're
Right.
taking that lower rate. Well, what if it drops by 2 points?
Right.
You know what I mean? What if it just drops by a half point? The bottom line is that, listen, you're buying an interest rate down that's already 0-point in the 2s with the idea that I'm staying in this house forever and you're going to realize that gain. Sure.
Right.
But I think statistically, homeowners move every 5 to 7 years, refinance every 3 to 5.
Right.
So unless you're dead set, I'm staying in this mortgage, I'm not leaving it.
Right.
Well, if you don't, you just wasted your money.
Yeah.
It's kind of like insurance, though, to me.
Sure.
You get what I'm saying? So I agree with everything that he just said, but
Right.
I feel like it's a little bit like insurance, especially if I
Just
agree.
in case it don't happen.
Yeah, you know what I
Right.
mean? So, but I agree with you.
So someone paid $2,000 to buy their rate down, and let's say it brings the payment down $20. How many months would you have to stay there, saving $20 to equal $2,000?
Precisely.
Right, and that's the thing.
That would
so you're
make
gonna stay there
sense.
100 months.
Yeah, so you gotta
to make up for it.
You need to talk to James or somebody that knows what they're doing, so that they can give you your schedule, so that you can see how long you need to be in there.
Right.
But yeah, in that situation, I probably wouldn't do it. But
I'm not saying that it's a bad thing. I'm not saying that there are opportunities out there, quite frankly, where it does make sense.
Right.
I'm just one of those people. I've been doing it long enough. I've seen the market come, go. I just always think there's going to be a chance to be put in a better position.
Right. Right.
I agree. I mean, I think it mainly, when you get into the buyer's market, when you can have the seller paying for some of that, is where it makes sense.
Oh, yeah. Absolutely.
Oh, yeah. Then that definitely makes sense if the seller's paying for it.
And that's what
negotiating. Yeah.
Right.
But in this market, it's a strong seller's market.
For sure. So how long do you see? So do you think that we're headed anywhere near? Do you think within the near future, crystal ball, we're all just we don't know, right? Just our opinion. And this is for everybody. Do we think that we're going to be anywhere? Are we shifting towards a buyer's market?
I don't think so.
I don't think so either.
It's just not enough inventory. It's still not enough inventory.
Yep. Yeah, the amount of sales they've done in the past 2 years, it didn't even put a dent in the actual housing that we need.
Right. We don't have enough supply. It's not enough new construction. We're not.
Me and Janita argued about this yesterday.
Yeah.
Was it yesterday?
That was yesterday.
Oh, okay.
Yeah. I said the same. I feel like we're not anywhere near. I mean, so you want to tell your part or not right now?
I mean, it's up to you, Master Guru.
Go ahead.
No, okay. So this is my thing. I watch the market. Shaka does not watch the market. And what I mean by that is I'm looking at the back end. I'm looking at closed sales transactions. I'm looking at the changes as far as like the days on the market. And I'm looking at the closed sales, where their concessions given, how many days is the house down on the market, plus where their concessions given. Like, do any of these things that we were traditionally seeing in the buyer's market, have they been surfacing again? And what I'm seeing right now is, yes, we're still in this crazy market where you're getting 17 offers per house, crazy appraisal guarantees. However, for like super regular properties, meaning like they're not old properties that damn near look like new construction plus character with high-end finishes. Right. They're like the more regular properties, you're probably seeing like now on average 2 to 3 offers. And then you're also seeing where the houses were on the market longer. And then you're also still seeing where concessions were given. And so to me, I'm just coming from a standpoint of like, I don't know. I do believe that we're softening and plateauing out and kind of just correcting. But at the same time, I'm like, we could be coming back into more of a buyer's market.
I want to rebut that first.
We so far away from
Hold on.
I can't even complete. You see what I can deal with? I can't even get my conclusion here.
I'm sorry.
You know what I'm saying? And so this is still all our opinions or whatever. But I do think that we're coming back into a space to where buyers are going to be able to negotiate more terms. Hold on. And one point to that is because a lot of people are doing a lot less to get the job done now too. So like you have a lot more properties that are on the market that got old ass cabinets from the 70s, old ass bathrooms from the 70s. I mean, the only thing that the people are going in here and they're doing is enough to get through the appraisal. So now they have to negotiate terms.
So my rebuttal to that is, first of all, I definitely watch the market. I don't do what she does. So I got just basic indicators for me, right? I don't need, so she dives a little bit deeper. I don't feel like I need to dive that deep right now. So I think that's what you're misconstruing. So yes, you brought up you basically made my point for me. People got lazy and they were able to put shit houses up and get the highest. You can't do that as often anymore.
Right.
But if you go in, you do a really good job of updating your house, you're going to get the highest value for it still.
In a short period of time.
In a short period of
Right.
time. And you're going to still get a whole, because you're still, think about this. You may not be getting a lot of showings, a lot of offers, but you're getting a lot of showings. You get what I'm saying? So that means people are still interested. They're just not interested in the shit.
Right.
You know what I mean? They want nice homes.
The shit's still selling.
It is.
Yeah,
but
that's why
And,
it's not
and
a
you
buyer's
also
market.
you're getting an influx of bullshit. So like if go James, when you get home, tell your wife to log into her MLS, get on there, and when you search whatever you work at the most common, see how many houses are active that have all the bells and the whistles versus how many houses that are active that do not.
Sure.
But that ties back into a few things. So I agree with you, but I just don't agree with the fact that we're going to a buyer's market because the demand is still outweighing the supply, right?
I said it was gonna be tomorrow.
But
I said we're coming back.
Part of why people are not fixing those homes like that is because of the issues with getting contractors in and getting it done in a timely manner. So you say, okay, instead of me doing a complete rehab, I'm going to do what's needed because this contractor can be in and out in 3 weeks versus waiting 4 weeks for the contractor and then another 6 weeks for the work to get done.
I disagree.
And then you're trying to look at how much is it going to cost to put into it versus what I'm going to get out. Maybe I just do just enough to get it sold. Because I'm trying to move and buy my next house. I don't want to be tied up with this property.
Or they just
3 months.
lazy, and they just
I
trying
don't
to
think
get
it has to do with. I
get
don't think it has to
the
do with
highest
contractors.
return.
I don't think it has to do with lazy. I
It's a
think it has
combination.
more
It is.
to do with the fact that they do not have to do it to get it sold.
That's
then-
because it's a seller's
But hold on,
market. They
yeah.
don't
Then
have
you're
to.
counter. That's counter
I
what
never
you're
said,
saying.
I didn't say it wasn't a seller's market. I never said we
You're
weren't in
just
a
saying it's headed back.
I said
towards
we're
that
going
direction.
back, yeah, and
Okay.
and I think we got to get through a certain amount of softening before
Right.
that happens. But I do see it coming back.
So I got a spin on this that y'all ain't thought about yet.
Right.
Okay.
That's why you're here.
So I understand exactly what you're saying. You all actually have very good points.
Right.
But how hard has it been to get a 3% down conventional, a 5% down conventional, FHA, VA? Good luck.
Right.
They don't want to
Yeah.
look at it. Cash, conventional.
Yeah.
Now your 5% down buyers, they're being looked at.
Okay.
They were
Right.
thrown to the wayside before.
Right.
Now your FHA deals that might need a little bit of help with concessions,
Right.
you can go out to that listing that's been sitting there for 2 weeks that hasn't sold yet and negotiate with that agent.
Right.
That's the softening up part per se.
Yeah.
You're absolutely right about that. But I think there's been such an influx of buyers
Right.
that, quite frankly, have tried as hard as they can for the past 2 years to get into a house, getting absolutely destroyed
Yeah.
by better qualified offers.
Right.
And now those people have a fighting chance, and that's going to be your next wave.
Wave. Yeah.
Okay.
The second chance buyers. That's what we're gonna call them.
I like it.
The people that backed out in 2021.
They was scared, right?
They was like 2020 is gonna crash. I'm gonna wait. 2021 they was like,
Oh my
we
God.
back in the game. Then it was like, oh, we not back in the game, right? And then now they're like, oh, we stand a fighting chance. Let's get back out there, team.
Yeah.
Right? So that's the, like he said, next wave. That's a good point. I
Okay.
didn't think about that.
Yeah, I mean, I think that they're all good points. They're all opinions at the end of the day. There's a lot of speculation as to what's happening in the market. But one thing that I stand by particularly is that I think real estate is still good. I think that we should still be buying. I think that we should still be investing.
Yeah.
And I just don't see us coming into a space to where. But even the crazy thing is, for me, even during a recession, people would ask me like, "Oh, what do you think about the market?" That was like the common question. Like, what do you think about the market? And I'm like, "Shit, I think it's good." What you mean?
I got one. So when it was a few weeks back, I think it was Quicken or one of those companies, they laid off a bunch of their employees. And one of my investors called because he's got 2 Oak Park properties he's working on. And he's like, man, is the market going? And I'm like, dude, you still got 8 buyers for every house in Oak Park. And I told him most of those employees probably were hired on to handle the refinance boom.
Yep.
And since that the rates increased, they're no longer needed. Right? Are you seeing the
100%.
same thing?
So anybody that has been heavily focused on refinance,
Right.
like that button just went off, right? 'Cause
Yeah.
it's not there. I mean,
Right.
no one is refinancing to take out money, or you might have the equity, but no one's giving away that golden rate in the 2 or the 3s.
Right.
And although I'd love to do it for my clients because they pay me to do it, those types of situations, I'm referring them off to people that I know to do an equity line for the home improvements. If they got debt they want to consolidate,
Right.
that's a better way to do it. You don't mess with that primary mortgage.
Right.
So Quicken is heavily a refinance business. They always have. I
Right.
think UWM as well.
Yeah.
And listen, there's professionals, whether you work at a bank, a direct lender, a broker, there's good and bad in all of it. But I think a lot of the newer loan officers and some of the companies that always were highly focused on the refinance, those are going to be the situations where you see a lot of people being cleared out.
Right.
Even Caliber, I mean, we're a highly focused purchase company, always have been.
Right.
And we've had people that we've laid off too, just not as large, not in the numbers as you would see of like a Quicken or a UWM.
Right. So explain real quick, because you said you will refer them to like a home equity line.
Yeah.
So if let's say their balance is $200,000, now the home is worth $300,000. They have $100,000 in equity, but they brought this home years ago. Say rates were 5 or 6% then, and they come to you and they say, "I have $100,000 in equity. I want to refinance. I'm not too concerned with the rates because they're almost equivalent to what I have."
Yeah. And then you do that deal all day. Would never refer it out to an equity line because
Okay.
now you've got it all in one locked loan.
Right.
Well, locked
They
up
waited
all
too
in
long.
one loan.
Yeah.
Yeah.
They should
But, I
have
mean,
They've been living under a rock
year
for 2
ago.
years
Yeah.
if they're
But
that person. But
The point I'm making is that even though the rates went up, there are still people that will still refinance,
Sure.
and it's beneficial because of the amount of equity they have.
But that's what
Absolutely.
he's saying. But,
Yeah.
but that's where the equity. Well, it depends on what your interest rate is, because then
Right.
you wouldn't go with the refinance, the cash out. I mean, you wouldn't go. Yeah, you wouldn't go with the cash out. You would go with an equity line of credit.
Precisely.
Right.
Yeah, there's
Right.
definitely opportunities out there where somebody doesn't have the most favorable rate. They do have a lot of equity.
Right.
And doing the refinance all in one loan makes all the sense in the world.
Right.
I'm talking strictly like, especially if you're taking out like a huge equity line, because typically they're based on prime, which is what the government keeps increasing every time the feds meet.
Right.
They're adjustable on a month-to-month basis.
Okay.
Most of them cap out around 14%. So like you don't want to be stuck with a $100,000 balance
Right.
at a 14% rate either.
Right.
But, you know, if you're cleaning up credit card debt or doing home improvements and you just don't want to go into your investments or whatever the case is, I still think that's by far
Right.
the best way to get those funds in your hands without having to affect the golden primary mortgage that you don't want to mess with.
You only pay on what you're using. That's the other thing.
Bingo,
right?
bango.
You know,
Yeah, exactly. And with those equity lines, they're efficient too because, you know, just in case, whatever, if restrictions go up, kind of like in 2008, 2009.
Right.
Like I have an equity line. I
Right.
use it for the purpose of having it for emergency funds because it still is a tax deduction. The interest is, and
Right.
it's like one of those things I'd rather have it than
Yeah.
not. So there's still a lot of usage to it per se.
Okay.
But yeah, with the equity lines, it's like one of those things, depending on your income and how comfortable you are with the flexibility of what that payment's going to be type deal.
Okay.
You want to do that for, you know, probably more of a minimal balance thing.
Okay.
Not to mention, most of them, there's no cost basis. They don't charge you for appraisal, title, anything like that.
Right.
Most of the lenders will have some kind of a prepayment penalty, but nothing like the days of old, $400 to close the account early within the first 10 years or something like that. But when you get, I mean, appraisals nowadays, good luck finding somebody that's going to do it for less than $600.
Right.
Because, I mean, they're almost a commodity in their own right. Y'all know what it's like
Right.
trying to order an appraisal,
Yeah.
and it's like, all right, when's it coming in?
Right. Yeah.
Right.
When are they coming out?
Yeah, when are they
Like,
calling? Yeah,
Right. That's
exactly.
the thing. Like, jeez.
Yeah.
OP. So yeah, that's one of the things when it comes to refinancing. A lot of times you have loan reps that are just doing a loan, and then you have some loan reps that kind of lay it out for you, like this is what this looks like compared to this, versus is hey, yeah, we'll do it.
And if they do that, you got a bad real estate professional.
Right.
I mean, like, but even
Hopefully-
on the sales though, right now, some people, I've gotten a couple calls, and it's like we're ready to list, and we just bought. I got a call from the people on Piedmont, and I was like, "How much do you want to pay?"
Right.
Because she was saying that, you know, like things went up, and I'm like, "Girl, you better keep
Stay
that
there.
house."
Right. Yeah.
Like even with that, you know, I think we were talking about that earlier today. Like, you know, shoot, it's almost cheaper to keep her, right?
Yeah.
Yeah. Sure. Yeah.
Yeah. And my parents are going through that right now. So my parents bought in 2000. No, not 2000. 96. Yeah.
Oh, wow.
Way before
1996.
I knew anything about
Yeah, I was in real estate then.
So they've got a
Yes.
1996 build, 3,900 square foot colonial in Shelby Township.
Oh,
And listen, three
800,000?
boys, we're all
Right.
grown. Everybody stayed out of
Right.
jail, pays their bills. You know,
winning, huh?
mom and dad
Yeah.
raised us right. So all married, all with kids.
Right.
And now they're the empty nesters. They got this big giant home that my mom doesn't want to take care of anymore.
Right.
But the catch is, like, unless they do significant improvements,
Yep.
master bathroom, kitchen, clean up the mess that my father's basement is with all the boxes, all that stuff.
Right.
It's like for them to go out and buy a 2,000 square foot ranch, new
Yeah.
construction, it's like I'm trading a 4,000 square foot home for a 2,000 square foot home for triple the taxes and
Yep.
a much higher interest rate and basically a comparable purchase price and payment.
Right.
So it's like,
Yep.
what do you do?
Cash something
But
out
they
and
might
let
have
us
a
buy
lot
it.
of they
Yeah,
might,
something.
they have a lot of equity, right? And then
Yeah.
they refi.
They do.
No, they got a lot of equity, so they might can sell it and then just pay cash for the house.
That's
Yeah.
all it. Yeah. Cash
You're
it out.
downsizing. So I get it. So their home is worth this without any upgrades. They'll spend probably equal or more for a new home, but a smaller home.
Mm-hmm.
So it's like, why sell something bigger for something smaller if there's
Precisely.
no upside
Pay
financially?
Then you got-
cash for a condo, and then let us investors move that stuff out the basement,
Yeah.
and I'll buy it. I'm just saying. Okay.
good.
All right, James. Anything that you want to leave us with?
This has
Thoughts?
been awesome and fun. I don't know, like, that I have any worldly wisdom
Okay.
per se. I mean, I wish I had something that was
Yeah.
like, oh, that was great. But I think that anybody that, grinds and, it keeps putting in 100% effort, it's not going to be as easy.
Right.
But the business is out there.
Right.
It's definitely out there. I think that with this market, and it's nothing negative. I don't wish anything negative on anyone, but there's going to be loan officers and agents that, quite
Yeah.
frankly, they're not going to make it. And once again, no ill will, but I'd be lying if it doesn't put a little bit of a smile on my face, because I don't want to deal with the guy that's been answering the phone and barking out a rate with nothing else to give in value to a client that I have to compete with on a day-to-day basis.
Yep.
So this is a time where the really high-end professionals get market share.
Right.
And some of the people aren't going to make it, and God bless, they just ain't going to make it.
But they're gonna
Yeah.
go back to work, so inflation will go down.
And
So
what's gonna happen.
but that's a gem. Before we wrap up, that's a gem right there for the consumers out there. Some of the people you're dealing with, they may seem professional, but they're not tested, right? So you have to really vet who you're working with, the real estate professionals you're working with, to see if they're really a good professional.
Knowledgeable.
Because you can end up with somebody that just so happened to answer the phone that day, good rate, and they start the deal, and it ends up being the worst decision you ever made.
Oh,
So-
absolutely.
yeah.
It's not always just about rate and cost. I do think those things obviously are important, but I mean, Warren Buffett said it best. Price is what you pay, value is what you get. And
Yep.
when you're working with a veteran, whether it's a real estate agent or a loan officer,
Right.
that level of expertise that you get, because it doesn't matter how clean your profile is, how perfect you think your situation is,
Right.
something could pop up. And if you're not working with someone that knows how to
Fix it.
Yep.
pivot, fix that. It's the difference between that was the most god awful experience I went through, or I didn't get the house, to
Right.
man, that was really easy.
Yeah. Yeah.
And there's something to say about that.
Definitely.
Okay. James, where do we find you?
Meaning,
Like social media, Facebook, Instagram, Twitter.
yeah. So I just hired a
LinkedIn?
marketing company. I got Facebook. I'm not really too hip on that stuff. If I'm being honest, my wife's kind of taught me how to work all that.
All right.
But yeah, James Taveggia, Taveggia. I'm on Facebook. I have a Caliber web page. I have a review page. I have an Instagram account I haven't even seen yet, 'cause the marketing team is
Right.
working on that for me. But 586-722-8800. Call me. Let's chat.
All right.
Okay. That's a wrap.
That's a wrap.